One of the most reliable tools in price action is the trend line. It's simple to use but incredibly powerful when it comes to spotting breakouts. A trend line is a key tool in technical analysis that helps traders determine and visualize the direction in which a market is moving. To spot a trend line during an uptrend, you connect a series of higher lows with at least 2 points. This shows that the asset's price is rising over time, indicating bullish market conditions. For a downtrend, you connect at least 2 lower highs. This reflects that the price is declining over time, signaling bearish market sentiment. A frequent issue traders face is figuring out the best way to draw trend lines. Should you connect the wicks, the candle closes, or the bodies? Draw your trend lines in a way that captures the most touch points. The more touch points a trend line has, the more dependable it becomes. Now, let's consider another example. Here, the market is trending downwards, forming a clear trend line. Notice what happens: a breakout above the trend line. This breakout suggests that the market is likely to reverse or at least make a move upward. Identifying this breakout early helps us catch the new upward trend as it begins. However, trading trendline breakouts alone isn't enough. Based on my backtesting, bullish breakouts have a success rate of around 62%. Bearish breakouts have a success rate of about 55%. While these numbers are decent, they're not reliable enough on their own. That's why we need additional tools to enhance the accuracy of this strategy. And this is where the volume indicator comes into play. Okay, now to view volume on TradingView, head to the Indicators tab, search for volume and select the Standard Volume Indicator. This tool uses vertical bars to represent trading activity. The taller the bar, the higher the volume. For example, a green bar shows strong buying interest on a day when prices rise, while a red bar reflects high selling interest on a down day. Here's why this matters. When price movement is backed by high volume, it signals strength and conviction behind the move. A green candle paired with high volume is especially bullish, indicating buyers are fully in control. Similarly, a red candle with high volume suggests strong selling pressure. Another way to think about it is selling interest. So for example, when we have a green candle supported by lots of volume, this is very bullish because not only is the price going up, but the price is going up while at the same time being supported by lots of buyers. On the flip side, when we have a red candle with high volume, it's bearish. The price is dropping and the move is supported by heavy selling pressure. Market makers know how you trade. They understand the patterns you trust, and the double top is a perfect example. Price hits a resistance level twice, struggles to break higher, and starts reversing. You think, this is it, a clear signal to sell. Convinced, you enter a short position and place your stop loss just above the resistance level. But here's what's really happening. Market makers are deliberately letting the resistance level hold just long enough to attract sellers like you. They know exactly where your stop losses are, clustered just above the double top. When enough traders have entered, the price suddenly surges upward, breaking through the resistance. This isn't a breakout, it's a liquidity sweep. Market makers trigger stop losses to create the liquidity they need to fill their own sell orders at higher prices. Once they've collected liquidity, the price reverses sharply and drops in the direction you originally expected. But now, you're out of the trade, watching the market move without you. The double bottom is a pattern most retail traders trust. It looks like a strong foundation for price to bounce higher. When the price tests a support level twice, you think, this is solid support. It's time to buy. You enter a long trade and place your stop loss just below the support level, confident it won't be broken. But here's the reality. Market makers know this is a popular pattern among retail traders. They allow the support level to hold just long enough to attract buyers and cluster stop losses below the double bottom, creating a liquidity pool. When the time is right, the price dips below the support level, triggering your stop loss and causing panic selling. However, this isn't a real breakout. Market makers use the liquidity from your stop losses to buy at a discount and fill their orders. Once they've collected enough liquidity, the price reverses sharply and moves higher, leaving you out of the trade and wondering what went wrong, even though you followed the pattern perfectly. Trend lines are a go-to tool for many traders to identify market direction and plan entries. They appear clean, logical, and reliable. But here's the truth. Market makers know how you use them, and they use that knowledge to trap you. You see the price respecting a trend line, touching it multiple times. With each touch, your confidence grows, and you decide, if the price touches the trend line again, I'll enter. As the price approaches the trend line, you place your trade and set your stop loss just beyond it, thinking it's a safe spot. But here's the issue. You're not alone. Many traders are using the same trend line, placing their stop losses just beyond it. Market makers recognize this predictable behavior and see an opportunity to create a liquidity pool. Instead of bouncing as expected, the price breaks through the trend line. Your stop loss is triggered, and you think, it's a trend line break, I was wrong. But this isn't a genuine break. It's a liquidity grab. Market makers use the liquidity from triggered stops to fill their own positions. Once they've collected enough liquidity, the price reverses and resumes the trend you originally anticipated. But now you're out of the trade, and the market makers have taken control.